Hello and welcome back to The Note. Equity markets have had quite a party this year, but there's been one big exception, which is the emerging markets led by the Brics: Brazil, Russia, India and China. Emerging markets as a whole have underperformed by some 40% over the last 3 years. Now, does that mean that there's value there, or are they still a value trap? With me now to discuss this is the Global Head of Investment Strategy for Russell Investments, Andrew Pease. Andrew, thank you very much for joining me today. Let's start by taking a look at how some of the biggest emerging markets are faring when it comes to exports. Do you see signs of a real recovery here?
I think so. We know that the G3 economies are probably going to have positive growth for the first time since 2010. Right. And we can already start to see that that's driving a recovery somewhat.
Particularly in India, where there's been great concern as well, which is interesting.
It is, and I think this is the first sign, particularly that you're getting that massive devaluation in the Indian currency starting to have at least some positive effect.
So you can see some form of balancing mechanism working for the emerging markets when it comes to the actual real economy.
Well, I think the one thing that is positive for emerging markets as a whole is that we are going to have slightly stronger developed economy growth, and that will be driving a bit more export demand across emerging markets, yes.
Okay, now let's take a look at valuation, because obviously the critical point with any investment is whether you can actually buy it cheap. This, as I understand it, is your own proprietary version of something like a Schiller PE for the emerging markets. Can you take me through how you've calculated this?
Yeah, so this is a cyclically adjusted PE ratio for the emerging market economy. So it's based on the 5 years of inflation adjusted earnings per share, and the earnings per share numbers are based on the bottom up stockbroking analyst estimates of earnings growth.
So this suggests that bar the very worst period after Lehman, or I guess the very worst period in the Asia crisis, we're about as cheap as we've been since emerging markets have been around as an asset class.
That's right. In a world where there's not much value out there anywhere, emerging market equities do look alluringly cheap right now.
Okay, now I guess the big question people would have is, one of the big stories from this year was taper talk. Ben Bernanke started talking about tapering off QE. Money flowed rapidly out of some of the bigger emerging markets, and it looked as though we had a potential emerging market crisis on our hands. What's to say that we don't get a real emerging market crisis when the Fed actually does go through with tapering off QE, or we see a real tightening in rates? Why should we be confident that there isn't more to go?
Well, I think realistically, before you take advantage of this value opportunity in emerging market equities, you would have to wait and see what the impact of actual tapering would be. The taper scare certainly did have a big impact, and certainly those current account deficit countries in emerging markets, particularly Brazil, India, Indonesia, Turkey and South Africa, had a big impact. Now, the positive story is a lot of that impact's already happened.
Right.
Taper actuality will be different to taper tantrum. So a lot of that adjustment has happened, but there may still be a little bit more to come. But if we do see a further shakeout in emerging markets on the back of taper scares, that might be when the opportunity becomes one worthwhile looking at. Okay,
so you're not arguing for diving straight in at this point, but you're suggesting that there could be a very nice buying opportunity coming up in a matter of months. Is that
I think
fair?
so. I think the things that are holding back investors from really embracing emerging markets as an asset class right now are fears about tapering, fears about further US dollar strength, and also fears in particular about the credit cycle in China.
Okay, so given that we've now worked out that the Fed is very important to this investment call, there's a FOMC meeting later this week. What do you think are the chances that they will actually surprise people by going for a taper before the end of the year?
There's a chance, of course, and the employment numbers have been strong enough to suggest that the Fed might be able to taper, and we know certainly they'd like to taper, but the challenge for the Fed is that the inflation numbers are still so low. That consumption deflator at just over 1% right now really isn't going to allow the Fed to taper. So our best guess is that they will taper at some stage during 2014, but March is potentially a more likely starting point than December.
Okay, Andrew, thank you very much indeed. I think it's very hard to disagree with much of that analysis. Looking around the world, it's very hard to see anything that looks particularly cheap. Emerging markets do, however, look cheap, at least on the equity side. The only problem, of course, is to wait to make sure that when the Fed finally begins to retreat from QE, it can do so in an orderly fashion.